guest is the author of Profits and Power, Navigating the Politics and Geopolitics of Oil, in which he argues that, yes, there is a future in oil and gas for investors. He has also warned that, quote, bickering and indecision among provincial and federal governments in Canada has deterred energy investment in this country and driven capital away from Canada. We're joined by David Tomasi, Professor of International Business at Queen's University. Professor, thanks very much indeed for joining us.
Thank you very much for having me.
Interesting, looking into the future, we know that a lot of investors have turned their back on oil and gas, whether they don't want the optics of being seen to invest in the space. But you think it is going to be promising for quite a while. It will offer rich returns for investors for quite a while?
I do. The demand levels for oil and natural gas, when you look at them, are not going to go down significantly for the foreseeable future. And by that, I mean decades. This is largely because the ball of global energy that's required is growing faster than is any individual kind of source that can be put into it. And because of this, I do think that they have an immense sort of level of return. And because we've been underinvesting in them in the last number of years, that level of return is probably going to remain elevated as we have a supply kind of crunch for a while.
It is interesting, though, isn't it? Maybe we could put up a 5-year chart for the TSX Energy Index. We frequently hear from guests on our channel that these stocks are trading at very low multiples, though. The shares themselves don't seem to move.
And that's been true. That seems to be true no matter even when oil and gas prices rise. Remember about a decade ago when oil prices were reaching $100 and then $140 a barrel. Mm-hmm. Even then, although the cash flow statements were wonderful, the stock prices didn't jump. I guess investors either, in this case around, I think there's a tremendous amount of social pressure on the ESG front to continue to stay away. Mm-hmm. And people don't seem to be able to square investing in oil and gas with some of those broader ESG promises that they've been making to their plan holders and their investors.
You're concerned about policy in Canada just not being friendly. But I mean, some people might say, well, Ottawa has approved at least 2 LNG plants. Production, oil and gas production in this country has steadily increased over the years. So is policy that unfriendly?
Well, if you take a look at the overall level of foreign direct investment in Canada, not just in the oil and gas sector, but abroad, it has been dropping. Mm-hmm. The regulatory approvals, again, not just for oil and gas sectors, has been lengthening. And our competitiveness is down and our labor productivity is down. So this is our general symptoms of the broader Canadian economic environment. And they hit particularly heavy in oil and gas because in addition to all of those, you have a growing reluctance, at least among the Canadian federal government, of being seen to be reinforcing a carbon-based economy when it's made pledges to move away from carbon as fast as it can.
It's a tricky one, isn't it? I mean, they did approve a $12 billion new oil program offshore off eastern Canada. They built the pipeline. I don't know what that's going to cost us. Is it $13 billion before that darn thing is built?
Well, if it is, I mean, the biggest problem in the Canadian pipeline is Trans Mountain.
Right.
Which Morgan sold for something like $6 or $7 billion a number of years ago. It's now going to cost $30 billion to complete, and it still isn't completed yet. So, and now as we saw that other people are getting into the game, like Mexico, the costs for those specialized services and products that go into pipeline development are likely to go up. So it's going to be becoming more expensive to do.
Yes, I'm sorry. Yeah, Trans Mountain, it's now about $30 billion. Yeah, monopoly money. 30. Yeah. It's
that we know of.
Yes.
And we're not done yet.
What is that? Is that inefficiency? I mean, I know we have a tough regulatory process, but is it partly contractor inefficiency?
Well, a couple of things. I don't think we have paid as much attention to the development of that project. I mean, it got waylaid by a number of things, both something having to do with it, whether or not we actually wanted to build the pipeline. Mm-hmm. To build it solidly would take a lot of solid federal leadership, and federal leadership for most of the last 3 years has been focused on COVID. And at that point in time, oil and natural gas prices were low, and the need to complete it probably didn't seem as pertinent as it does now. Yes. But the world's changed over the past year. Energy security is at the top of anybody's agenda. Canada's contributions to those things can be significant if we can get our oil and gas to shores and off market. And now I think the attention needs to be brought on it with a degree of urgency because, again, other countries are getting in the game.
Yes, well, we're tight for time, and I'm sorry, but Mexico is rapidly moving ahead with LNG projects, although a lot of that seems to be re-exporting American natural gas.
That's exactly what it is. There's only, if you want to get at gas to Asia, I mean, there's only so many tankers, liquefied natural gas, you can get through the Panama Canal. It's way faster and way cheaper if you can build some facilities on the West Coast. Canada could do that well. It's cheap to liquefy natural gas in Canada. We're cold. It's less expensive to do it.
Yes.
And we have a shorter route to get there, but you got to build the thing first. And others are seeing that and saying, if we can get there first, maybe we can steal a march and steal most of the market before Canada can even get there.
Thank you very much, Professor. I really appreciate it.
This is Bloomberg Markets. I'm John Ehrlichman. Canada is known for some of its great entertainment exports, successful Hollywood stars and singers, and in business, Cirque du Soleil, one of the best-known live show producers in the world. After some dark days during the pandemic, which forced the company through a bankruptcy process, Cirque is busy again with big shows, but it is also embracing the digital world. In fact, it just announced its first immersive experience on the Roblox platform. Stéphane Lefebvre is president and CEO of Cirque du Soleil Entertainment Group, and he joins us now. Stéphane, thanks very much for being with us. I guess let's start with this new digital adventure. How did this immersive experience with Roblox come together?
You know, we're so excited because during the pandemic, this was such a tough period for us, like many other businesses, but we were left with just a handful number of employees and one asset, our brand. And we asked ourselves, we gotta keep it alive. And so we created this hub called Cirque Connect to keep connecting with our fan base. And it turned out that we were literally overwhelmed by people's reaction. And we thought, wow, there's a bigger play out there. There's something way beyond what Cirque du Soleil did pre-COVID. Cirque du Soleil has always been one of the leaders in live entertainment, but we thought there's much more out there way beyond selling tickets for live shows. And we thought about, obviously, Metaverse. How do we penetrate that universe and make people connect with Cirque du Soleil's creative world? And we met with GamePlan, probably one of the largest immersive experience metaverse publisher in the US, and we started working on a game immersive experience last year, and we're about to launch the game in summer.
So I remember during the pandemic, my children spent a lot of time on Roblox, and you started to see these concerts pop up. So, you know, you're in these different worlds and you might stumble onto, a big entertainment event taking place. Is that one way to think about this? The same way that people gather at your big live performances, the crowds come. It's that in this digital world, people will come and gather in this world or sort of worlds within worlds concept?
It absolutely is the case, and it's very complementary with what we do. It will never replace our live shows, right? Tycoon, the game that we've announced this morning, is a game, but this is a first entry point for us in the metaverse. And so absolutely, I think what we see is that for, I would say, us more mature people, the line between my work and my game and my social life is quite distinct. But for the younger generation, that line is kind of blurry. And so it's a place where people can interact with Cirque du Soleil's creative world, but also socialize with a bunch of other people. There's about close to 70 million players on Roblox every day, right?
Yeah, no doubt. And Stéphane, obviously, while you're putting a lot of energy into this, we keep hearing, even though there's worries about the economy and inflation impacting what consumers have to spend, you keep hearing about a lot of people traveling, a lot of people getting out and doing big things. And obviously, the summer's a very busy time as well. How would you describe what's happening with your bread and butter traditional business right now?
I feel I got to knock on wood somewhere because our business started launching in Las Vegas in the summer of 2021. And it keeps increasing since then. So we've seen a lot of people coming back in Vegas. Initially, national tourism. Now we start seeing international tourism coming back to Vegas. One of our shows called and we're actually celebrating its 25th year this year. Absolutely phenomenal. We're running the show at over 90, 95 occupancy every night. So it's really good. as well as internationally. We were in Europe in one of our shows this winter, and we beat all-time box office records in London, in Seville, Spain. I have to say we haven't started seeing any slowdown in our ticket sales at this point.
Okay. And I guess just for our audience trying to figure out where the business goes from here, and we referenced going through that bankruptcy process and coming out the other side, how should we think about what, plans you have, broadly speaking, for the business of Cirque going forward?
I think there's a few strategic angles here that we give ourselves as objectives. And one of them is we need to think about deepening what we call the blue ocean. Cirque du Soleil is an extraordinary company. It has an amazing creative process, and we want to get people inside our creative process. And what we've announced today, Roblox, is one area for us to get people to get more connected with Cirque du Soleil. Cirque is all about performance, arts, emotions, and I think it opens up, gives us permission to play in so many fields at so many different levels. And so the announcement that we made today is one angle that we're taking in the Metaverse. But hopefully there'll be more that we'll be able to announce in the coming weeks and months.
Okay. We appreciate you shedding some light on the plan, Stéphane. Thanks very much. We'll be watching the Metaverse and real-world Cirque du Soleil experience. Stéphane Lefebvre joining us from Cirque du Soleil Entertainment.
Welcome back. After a couple of years of scant supply and strong demand, the automobile market is finally starting to decelerate. That's according to a new report from RBC. And that may put a lid on the performance of Auto Canada. For more, we're joined by Paige Ellis. Hi, Paige.
Good morning, Paul. Well, RBC initiated its coverage of Auto Canada this morning with a hold rating and a $19 price target. So that implies about 9% upside for the stock over the next 12 months. Not exactly a blockbuster performance. It also means that RBC is among the most bearish on the street. So the most bearish view would be at Canaccord and National Bank, which have an $18 price target. So they're just $1 above that. Now, Auto Canada, for those who aren't overly familiar, buys up auto dealerships across Canada and the United States. RBC says that they've made a lot of good progress since that big management shakeup a few years back. They're more diversified geographically and in terms of their brands. They're also selling more. They also have more exposure to used vehicles, which they think is a good thing. However, they say in the short and medium term, there are substantial headwinds that are going to limit the upside of this stock. And it really comes down to some pretty basic supply-demand dynamics. So, of course, in 2021, 2022, there was that microchip shortage, which led to huge supply disruptions in the auto sector. People are also pretty flush with cash during the pandemic, and so demand boomed. That translated into really strong prices, and it also meant that Auto Canada's stock hit a pandemic high in 2021. Now, RBC's analysts say the opposite dynamic is true. Supply is improving, demand is softening. So that, they say, is going to translate into more promotions, more incentives, and lower margins. But they say longer term, Paul, the road sort of smooths out. They say that dealerships, it's quite a fragmented industry. Apparently the majority, or half, actually 50% of the industry is single dealer operators. So they say that this company is well positioned to kind of lead the consolidation.
And this idea of deteriorating supply demand fundamentals is getting some pushback from some participants.
It is. So Auto Trader tracks this data very closely, of course, and they say that, as far as supply is concerned, is there an increase in inventory? Yes, but we're still down versus pre-COVID levels. And they characterize demand as robust, saying some of the drivers include stabilized interest rates, high employment, and people returning to the office. And they say the proof is in the prices. So here's a chart that they put out that shows that new vehicle prices are up 17% year over year in the month of March to reach an all-time high of just shy of 62,000. Used prices did contract slightly month over month, but they're still up 5% over last year to 39,000. And outside of minivans, used inventory is actually down quarter over quarter. So a little hard, frankly, to reconcile these two positions. I will note that on the street, there are 5 holds, 4 buys, and 0 sell ratings.
Thanks, Paige.
Thank you.
Paige Ellis on Auto Canada.
Well, if it weren't for the rally that we've seen in artificial intelligence stocks and anything that touches it, we wouldn't see much of a rally at all in 2023. Yesterday, it was NVIDIA, which is holding in at record high levels after it added nearly $200 billion in market value after saying its revenue in the next quarter, not somewhere down the line, is going to grow by 60%. Today, it's Marvell Technologies, also a semiconductor maker. It's rallying 25% after it says it sees AI growth doubling from here and expects that growth trajectory to continue. Marvell not quite at an all-time high, but the highest level in a little more than a year right now. When you're talking about such huge numbers and obvious enthusiasm, it makes you wonder, are we in a bubble? Are we just in the beginning? Is this time different, or is this time the same? Let's put this to Mark Lehman. He's the CEO of JMP Securities. Mark, thanks so much for joining us. You're getting this question a lot, I imagine. How do you frame this when we talk about returns that are this large before we've really seen the impact of AI in our lives? How do you answer that question, whether this is sustainable?
Well, it's a great question, and we may not think it's impacting our lives because we don't see it and feel it, but it is. And clearly it's impacting the companies that are benefiting from it and the revenues that these companies are benefiting from. So lots of parallels will be made to the bubble of 2000 and some other times when stocks went up massively. But what we're seeing this time is stocks going up on earnings beats and revenue beats that are stunning. As you just pointed out in NVIDIA's yesterday, and the performance of the stock. So I want to separate this kind of bubble hype lingo that's obviously going to keep going on from what NVIDIA actually reported, which was a massive upside and obviously clears the way for big earnings beats over the next few months and quarters.
Well, I want to clarify that a little, because what NVIDIA actually reported was a sales drop. It was what they forecasted that the stock rallied. And even with Marvell, even with their forecast, it's still a sales drop compared to last year, because there's other things going on in semiconductors, and this is one pocket of strength. And I guess that's where the skepticism comes in. This rally is still based on estimates.
Well, right. Stocks anticipate earnings. Nobody says, boy, we did really well 2 years ago, so our stocks should be elevated. So you're right. But this is the future, right? You see such disparity between the haves and have-nots. And you're talking about semiconductors. Now, think about what Intel had 20 years ago, a massive lead, a massive war chest, all the Intel inside chatter, and Marvell, and even AMD has eclipsed their market cap because of what they've done in terms of performance. So these companies are adapting, they're changing with the times, and a lot of the viewers and a lot of us didn't hear about this future with chat and AI and all the things that it's going to promise even 3 to 6 months ago. And the effect on this technology market and the NASDAQ and other stocks has been so profound. It's a reminder of how much innovation is actually going on and how much is really, at times when we feel a little bit pessimistic about stocks and pessimistic about the market, you have these opportunities, why you have to stay invested.
This rally in some ways is similar to past innovation cycles in that semiconductors lead, and then they hand off, in the case of mobile, they hand it off to devices, and then it handed off to the software that was built on top of it. Do you see a similar evolution playing out here with artificial intelligence?
That's really a great question. I think we're going to see those patterns, I think, repeat. The things that we have to be really cautious about is the number of people who are going to say they're an AI company and that we're benefiting from that. Every boardroom, every C-suite is thinking about how do we play this. But I think the ramifications across different verticals is much more profound than in previous cycles and in previous booms like you're talking about. So the impact on healthcare, the impact on consumer, the impact on all the things manufacturing that we're talking about is going to be so profound that I think figuring that out today is incredibly difficult. And I think being very flexible and obviously finding those winners is going to be such a hard task for individuals and portfolio managers. But I think the ramifications are that vast. So I think you're thinking about it correctly. But But I think it's really hard in mid-23 to figure that out today, just because it's so early and so profound how much change is going to happen here. The cycles you're talking about, whether it was starting with Intel in the early 90s and Microsoft and the Wintel monopoly that we talked about, in 2000 with the beginning of, software and mobile and all that. And then we saw 2010 with cloud. All those are spoke to much bigger markets. Each one of those, shockingly, got bigger, 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 bigger. And this is what's going on with AI. This is going to be the biggest one we've seen ever. And we're just in the beginning of it.
Okay, so there's the obvious names we've talked about. Your job is to run a group of analysts and a group of bankers who are to find and unearth those hidden gems that are not fronting, are not just, sprinkling that AI fairy dice. Can you toss out a few names that are perhaps flying a little bit more under the radar than an NVIDIA right now?
Well, we're definitely trying to find early stage companies here at JMP, and my colleagues at Citizens also are trying to create opportunities for innovative companies that are both public and private. I think what we try to do is find companies at an early stage of investment and help them grow. Oftentimes when my mom asks me what I do, I try to help little companies become big companies. So I think it's really important. If we look at some of the companies who are not really on the forefront of the chat and the AI lingo, you look at some of the software companies that you talked about that may be the second beneficiaries of that. We look at companies like SAP, which is a little bit of a less well-known company here. It's based in Europe, but it does a great job and is moving more towards the cloud and more towards AI. We really like Snowflake, which is a company that reported earnings this week and has been having somewhat of a shortfall in terms of earnings expectations, but it's one that we think will be a massively transformative company. We look at Cloudflare, which is a company that we like here a lot, which is a cyber company will benefit from the things. And then I think what thing we really have to look at is some of the really smaller companies that went public and currently in the early cycles of 21 that are not performing as stocks, but are really being disregarded. You talk about this narrowness of the market. The smaller companies are having a really hard time and are having a really time finding their footing. But look at 2002, when the market was really coming out of the doldrums of 2000. Some of the best performing stocks were some of the worst performers of 2001 because people just threw them out. And I think that's going to be a great exercise for portfolio managers to find these companies that are actually transforming themselves right now, will benefit, and are right now disregarded by investors.
You also have a lens, as you mentioned, into getting those smaller companies, both private and public, to bigger companies. When do you think we're going to start to see this come out in the form of IPOs?
I think we're probably not going to see it this year. Because the tech IPO landscape has been so rocky for the last 18 months, you're going to see bigger companies try to go public first, the bigger, more pronounced companies that I think have visibility in earnings. What you might see is some really smaller companies by some smaller brokerage firms and not the biggest firms that we've heard of, take some companies public and say, we are AI companies. And I'd be leery. I have no names to give you of those companies, but everybody's going to try to jump on this bandwagon. And I think investors have to be really careful because we've seen it in previous cycles, like you said with software, and like we've seen with gaming as it proliferated, like we've seen with other things that have taken heart. It's very easy to call yourself one of those winners, and it's very hard to execute.
All right, Mark, thanks so much for joining us with this perspective and insight. I appreciate it. That's Mark Lehman, CEO of JMP Securities.